Hello and welcome to the lecture for Chapter 9, which deals with absorption costing. So we'll get into some details about job order versus process costing, and then I'll walk through some techniques and some arguments for best ways to do this. This subject is increasing in importance as manufacturing evolves. And this can be applied to both a manufacturing environment or a service company. The basic thing that's happened, if you can think about what's gone on over the last 100 years, is since managerial accounting was first developed in the very beginning in the early 1900s, the majority of cost in any product were direct materials and direct labor. There wasn't a lot of overhead. As manufacturing has gotten more refined and as it's gotten more mechanized or in the use of robots and more expensive machinery, the labor portion has reduced and the overhead portion has increased. So how we apply that overhead to the products that are manufactured becomes increasingly important. So in this chapter, I'll talk about the way that it is required to be done by generally accepted accounting principles. So the way it's done for external financial statements. And the next two chapters we'll talk about some of the problems that can lead to and some other approaches you could take for internal analysis that can lead to better decision making. So I'll try to get through this chapter in one video rather than splitting it up. I think that'll work okay. So there are two types of absorption systems. There is the job order costing system and the process costing system. So the job order costing system is used in companies where the output, whether it's a single product or a batch of products, is distinct from other products or batches. So a good example of that I've used in past courses is custom home building. So if you drive into a neighborhood and there are nice houses, of course, each person that buys a brand new house might want to decide what kind of countertops they want or what type of plumbing fixtures or what kind of amenities that they want in their house, flooring and so forth. So when it's completed, each house is different than the house next door to it. So we want a system that accumulates cost precisely by the specific job. In that case, it would be by the custom home that's being built. Process costing, in comparison to that, is used in a situation where every product is the same. If I'm working in a company and I'm making bags of concrete, one bag of concrete is the same as the next bag of concrete. So I'm not worried about applying cost to one bag versus a different bag because I can average, they're all the same. So the reality is that a lot of companies have elements of both in them. When I was the controller at Big Toys for the latter half of the 80s and most of the 90s, we had a sawmill in Eastern Washington that supplied us with material. In sawmills, each 2x6 or each 4x4 is the same as the one before it. So I used process costing at that facility to come up with cost of products and the way I accumulated direct material, direct labor, and factory overhead and applied them to what was being manufactured. But then when that product came over the mountains to the west side where we built playgrounds, every playground we built was customized because of the location and a bunch of different reasons. So in that case, we used a job order costing system. So a lot of companies have a little bit of both in them. So job order costing, which we'll talk about most, the objective is to get all of the manufacturing cost applied to particular products. So those products are either going to have left with a customer and be in cost of goods sold, or they're going to be sitting in inventory, either in work in process inventory if they're not complete, or in finished goods inventory if they're done. So those costs are going to be comprised of direct traceable costs like materials and labor. That's pretty straightforward if you can keep track of where things are moving to say what exact materials went to that housing lot. And if I have good time cards, I'll know as an example how many hours of labor each person spent on that particular housing lot. So that's pretty easy if you're somewhat organized to track. The tricky part are all the manufacturing overhead costs because you can't directly trace those to a particular project. In the example of a custom home builder, I've got superintendents that are driving around checking to make sure people are doing the right thing and following safety rules and calling up vendors and those sorts of things. I've got purchasing agents that are issuing purchase orders for materials to be dropped to different lots. I've got all kinds of different manufacturing overhead costs, and I have to figure out how much of those costs should I apply to this lot versus the lot next to it versus the lot in another neighborhood or one down the street. So that's where it gets kind of tricky, and that's what we're going to talk about here. So the way companies do that is they come up with an allocation base. That's some measure of input. And important, it's input, not output. So input is how many labor hours were spent on each house, how many direct labor hours in that example. In other factories, it might be how many hours did the machine run on a particular job, that sort of thing. And then I'll come up with an overhead rate at the beginning of the year and apply that to jobs as we go throughout the year. It's important when we make those choices that we recognize that some of those choices about what we use for an allocation base, as an example, could create perverse incentives within the company to, in effect, lower their allocation, lower a job or a department's allocation of overhead, but not really helping the overall organization. So we have to be careful about not creating improper incentives. So here's an example of a job order cost sheet. So I would have one of these job order cost sheets, and granted this one's on paper, but it could also be a record in a database, of course, where you can see that this on different days, different types of raw material, different quantities, different dollar amounts are going to this particular job. That's in the left side there under raw materials. On the right side under direct labor, time cards for payroll are showing me the different amounts of or different types of labor, different employees at different classes are spending different hours at different wage rates on this job. So those are my directly traceable jobs, or cost rather. And then this company chose to allocate overhead based on machine hours. They have a rate of $25 per hour that they came up with at the beginning of the year, and I'll talk more about that in a minute. And they applied it based on the actual machine hours incurred for this job. So they applied, in this case, 5,325 of machine hours. So I have a total job cost of 36,894. Now this was a batch job that had 1,560 units in it, so I can come up with a fairly precise cost per unit. Now I can use that cost per unit to charge cost of goods sold when I sell the product or to value my inventory. But again, I'll have one of these job order cost sheets for each job in my factory. In the case of that home builder, I'd have a job order cost sheet for each custom home in every neighborhood. So if you think about work in process inventory, that's inventory that is not done yet. It's not ready to go into finished goods. I should have a binder that's got these job order cost sheets in it, and the total on all of them should add up to what I have in my accounts in my work in process account. So the cost flow sequence, you can see here, we'll start on the top on the left there. I incur labor costs. That's a debit to my labor clearing account. And then I apply that to jobs. So I credit direct labor and I debit work in process for the work that's directly gone. Every time I touch the work in process account, I update those job order cost sheets. So that's for workers that are putting their hands and actually changing the product. Indirect labor, supervisors, quality control inspectors, drivers, things like that, that will come out of my labor account and go into my overhead clearing account. That's where I'll accumulate overhead costs. And I'll come back to that in a minute. So let's jump down to the bottom. When I buy materials, I'll debit my material inventory account. Okay, that's on the debit side, the left side there. And then as materials are requisitioned for particular jobs, I'll credit the materials account and debit work in process. I'll update the job order cost sheet when I do that for direct materials. Indirect materials like glue and sandpaper, things like that that can't be directly attributed to a job, I'll credit materials because it's leaving the material inventory, and I'll debit the overhead clearing account. So now coming back to that overhead account, on the left side, I've debited for all the actual incurred overhead cost, which was indirect labor, indirect materials, and then other items like insurance and rent and depreciation and all of that. And then I'll up credit that clearing account by taking the rate that I determine at the beginning of the year and multiplying it by the actual hours on each job. So I'll debit work in process for that. So I'm debiting work in process for all three types of cost: direct material, direct labor, and applied factory overhead. When the units are completed in work in process, I'll credit work in process to move them out of that account and into finished goods. It helps to think of that as almost like a separate building that I move it to, although it doesn't have to be separate. So I debit finished goods, and it sits there waiting for a customer to take it. When a customer takes it, I credit finished goods and I debit cost of goods sold. So that's the flow of cost from direct labor, direct materials, and overhead through the different inventory accounts. So determining the overhead rate, as I mentioned earlier, it's done at the beginning of the year, so it's a prospective rate. Again, I can't wait till the end of the year to figure out what all of my costs are. That wouldn't be very useful. So I need to come up with an estimated rate at the beginning that I can use. So the numerator, the top number in that rate, is going to be annual budgeted overhead dollars, and I'll probably use a flexible budget to determine that. The denominator is going to be some estimated volume, some input measure. Some companies use machine hours, some companies use direct labor hours. Those are probably the two most popular. Some use direct material dollars, or some use direct labor dollars. You have to keep in mind, when you use hours, you're going to come up with a rate per hour. When you use dollars over dollars, you're going to end up with a percentage. So the thing that I want to choose for an input measure, I want to choose the level of input activity that actually drives the majority of the overhead cost. So if I have a highly automated factory, say I have a Tesla factory and there's lots of robotic welding and all of that kind of stuff, one of my biggest costs is going to be depreciation and engineering time keeping those robots running. So in that case, machine hours really drives the overhead cost that's required. The more machine hours that are required for a product or a job, the more overhead should be associated with that. Direct labor hours, I would choose that measure if the majority of my overhead was supervision related. The more workers I have working hours, the more supervisors I need. So the overhead rate, there was a discussion in the book that I wanted to highlight about expected versus normal volumes, what you should use for that denominator. And the book makes a very compelling argument that you should really use the normal long-term volume versus what you actually think you might do this year in the short run. The reason for that is, if you use, say, I think the book used an example of a new competitor comes in, they take some of your business, so your volume goes down. So now you're spreading the same overhead over fewer items. That makes you look less profitable for each item, which triggers you to raise your prices, which might be the exact opposite thing to do when you're facing new competition. So using the normal long-range volume versus the short-term expected can avoid that particular pitfall. So one of the things that's going to occur is we're going to have, in all likelihood, a residual amount left in that overhead account. And that has to be cleared out at the end of the year. That's a clearing account. It can't have a balance at year end. So we need to dispose of it in some way. And I'll cover that shortly. So that amount, that residual, can end up in that account for one of two reasons. Either our actual spending was different than what we estimated, which of course we're never going to estimate perfectly, so that's highly likely. And then second, our actual volume might be different than our estimated volume, which of course is also very likely, and it could be some combination of the two. So we'll end up with either under or over absorbed factory overhead. So I have under absorbed overhead when the actual spending is greater than the amount that I have applied. I'll have over absorbed when the actual is less than what I applied. So it helps to look at some T accounts here. So when I talked about cost flow earlier, you could see that I was debiting the overhead clearing account for actual and then crediting that account to apply. So if I end up with a credit balance, that means I've overabsorbed. A debit balance means I've underabsorbed. The book has an example where the actual overhead incurred was $2,565,000. I applied based on $25 per machine hour and 103,000 machine hours. I applied $2,575,000. So I applied 10,000 more. I applied cost to my inventory that eventually led to cost of goods sold or remains in inventory to too great an extent. And again, it could happen because of the two reasons I mentioned a few minutes ago. So disposing of that, there are three different methods for disposing of it. The first is to write it off to cost of goods sold expense. So in that example where I have a credit balance in my overhead clearing account, I would debit it to clear it out and I would credit cost of goods sold. So I would reduce my cost of goods sold expense by clearing out that factory overhead balance in the previous slide's example. So that's what most companies do if the amount is fairly minor, okay, which hopefully if you've gotten good at estimating it'll be a fairly minor amount. If it's a more significant amount, then companies would choose to allocate it among work in process, finished goods, and cost of goods sold based on how much overhead exists in each of those categories. So they would prorate it across those based on that math. The third method, which to be honest with you, I had never heard of before until reading this book, is to go back and recalculate all of the job cost with the actual overhead rate at the end of the year and make adjusting entries based on that. So that'd be very time consuming. The only case where I think that would be potentially worth the time invested in doing that level of precision, is if you have some cost plus projects where you build a building for somebody that is, you charge them actual cost plus 15%. Well, if you found out at the end of the year that your overhead was higher than what you'd been applying, you might want to go back and recalculate it so that you can charge the proper amount. So that's one reason. So the book next talked about plant-wide rates versus multiple overhead rates. And it's basically the argument between crude but easy and more refined, more accurate, but more time consuming. That's kind of the juxtaposition of the two ways of doing it. So I have an example here of a plant-wide rate. So I may just say, what's my total overhead for my factory? I'm going to use direct labor hours. So how many hours do I think I'm going to spend in the factory in the upcoming year? And so I have estimated overhead divided by estimated labor hours. That gives me a rate. I apply that to anything that happens in that factory, whether or not it's connected to direct labor hours. It could be a product that doesn't require much labor. It would still get that plant-wide rate. A better way of doing it is to come up with pools of different kinds of costs that are triggered in different ways. So in the example here, I have a pool of estimated overhead costs that's related to labor. So maybe I base that on labor hours. I have another separate portion of factory overhead that's related to utilities. Maybe that is more triggered by machine hours because I have energy consuming machines that make the products. So, and then I'll have some overhead left over like rent or the supervisor salary, something like that, that I just have as a general plant-wide rate. And then based on how much each product consumes of those different types of either labor hours or machine hours or the plant-wide rate, then I would allocate it based on that. So it's a little bit better. I honestly think doing multiple overhead rates is a better way to go. The last thing I wanted to talk about briefly, and we're not going to get into the details on this because it can get pretty complicated, is process costing. So process costing, as I mentioned earlier, is where you have lots of products that are all the same. One is same as another. So I'm not going to attribute cost to a particular product, but instead I'm going to gather costs by department. So I'll have different processing departments throughout a company. I think I've used an example before in previous classes of a company that makes aspirin. So I might have a department that mixes the whatever aspirin's made out of in a big vat. I have the second department that forms them into tablets, and then I have a third department that puts them into jars with the cotton in them and labels and puts them in boxes, packaging. So in that case, I would accumulate direct materials, direct labor, and I would apply factory overhead to the mixing department. And then I would look at how much, and that might be gallons of aspirin goo, whatever it is, and I would apply it so I'd come up with an average per gallon or liter of material, what the cost was. In the second department then, where I'm doing tableting, maybe that's really heavily based on machining. So I would take direct materials there. Maybe there are no direct materials added in that case. I have some direct labor, and then I would apply my overhead for that department based on how many machine hours were spent creating tablets. And then in the final department, I have some materials. I have packaging materials, and I have labor, and I might have some overhead there too that I would apply. So the cost at the end is going to be the sum of the averages of each of the three department costs, if that makes sense. So it's a little bit more complicated, but it's basically taking processing departments and gathering cost for that as a cost object as opposed to a particular job. So in this case, I would have a work in process account in my accounting system for each particular department. So I hope you found that helpful. Please, when you get into the assignment for these two chapters, please don't hesitate to email or call if you have any questions. Thank you.